Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsb@kaizencpas.com. Now let's get started.
Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast. I'm joined with Pierre, one of our managers here at Kaizen. Welcome, Pierre.
How you doing, Mark?
I am doing just wonderful, and I am excited to be talking about pension and profit sharing. It's the end of the year. What are the options for pension and profit sharing?
So pension and profit sharing is a great opportunity for you to reward your employees and also get some deductions and put money in your pocket rather than the government. But at this time of year, we're limited as to what we can do. If you have a plan established, if you have a 401k plan established and you need to add a profit sharing component, we can still do that. Profit sharing says we're going to take company money and we're going to give it to the employees. That can be done right now to the end of the year. If we don't have a plan established, the only thing you can do at this point is either contribute to your individual IRA or you can set up a SEP plan, which is a small employee pension plan. And those you can defer a lot smaller amounts, but you can do those all the way up to the tax filing deadline of April 15th. That being said, if you want to make a 401k contribution, we need to establish that well before the end of the year. So generally June, August, something like that, because the employees have to have the opportunity to participate in the plan, and the IRS says you need to give them 90 days. So you really have to have the plan in place by September so that they can participate in it.
And that's what you mean by having an established plan, because there's got to be some type of rollout to it. You can't just, as you said, you have the 90 days. You can't just throw it down and be like, quick, everyone sign up.
Yeah, because they know that people won't be able to contribute anything, and it seems like a scam at that point. Next year it'll be okay, but the first year you wouldn't be able to participate. So if you already have a different type of plan, you need to look at that before the beginning of this year coming up if you want to make a change. Because once you start the beginning of the year with a type of plan, so say last year you did it last minute, you put in your SEP plan. If January 1st comes around and you put $1 into the SEP plan, you're stuck with the SEP plan for one more year.
Okay.
But right now, if you say we did a SEP plan last year and say, hey, we really want to go to the next level to put more money away and put a profit sharing component, you have to set that up now starting January 1st, and then people can participate in next year.
Okay.
So something to think about. Timing is everything on retirement plans.
So can you give me, Pierre, some kind of like examples of how if you were a business owner, how would you set it up? What would be a good initial option for someone just doing their first one, and then what's kind of like moving up?
So you want to see how much money you have to put in that plan. Sure. So a large 401k plan with all the bells and whistles, you can probably defer up to $50,000, $60,000 per you and your spouse as the owners of the company. That's $110,000. But if you don't have $110,000 to put away, then let's not do such a big plan. If you say, I'm going to establish a plan, and I think we have about $10,000 to put in there. All right, for you, let's just do an individual retirement account. You can put in $5,000 for you and $5,000 for your spouse, and you've done that without having to share any of the revenue with any of your employees or establish a plan and go through all the paperwork and go through the 5,500 testing. Okay, so there's the breakdown. Now, you say, I have a little more than 5,000. In fact, it's more, and it's a little more if you are older. You can put up to 6,000 or 6,500. Say you want to put in 15,000. Well, that SEP plan, I believe it's either 15 or 12 that you can put into that plan. And you can establish that plan at this time of year too. So It really comes down to how much money you have that you're trying to shelter. All right. So when you do a SEP plan, though, you also have to have it available for your employees too.
Okay.
Then when you do a 401k plan, there are different plans where you have to match. You can either do a common match, you can do a minimum, you can do a safe harbor, but you're probably going to have administrative costs of running that plan, and you're going to have to have your employees participate and give them a piece of it too.
Okay.
So it all comes down to the dollars.
Okay. So you have you as an employee and then let's say 4 or 5 people. It is end of the year.
Yep.
Basically, you're looking at just profit sharing.
Yeah, right now you can say, now we say how much are we going to do this year to find out how much you're going to put in your profit sharing. And you really have up until the tax filing of your tax return next year to make that contribution. So now we can say, look, here's what we're planning is. We don't need any more equipment. We don't need anything else. Let's see what the final numbers are. We think we're going to be able to contribute $100,000, spread over the various employees to lower our tax rate. So if you're in the 37% bracket and you are able to shelter $100,000, that's $37,000 that you're sheltering. That's a good plan.
It's a good way, right?
And when I say up to the filing deadline to make that contribution, we're talking your 2023 year. You don't have to make that payment to the profit sharing plan until September 15th of next year.
Oh, okay.
So you have a little bit of time to do that. But you can't do any of it if you don't have an established plan.
Okay. And now let's say it's January. We're moved into the new year, and you say, okay, we may have a little bit more money. We have the time. What are their options then? Again, it's the owner, and then let's say 3-4 employees.
Yeah. So again, how much do you think we're going to have at the end of the year? And this is very tough.
Which is tough to decide, especially when you're at the beginning of the year. Which is why you want to kind of forecast it, right?
So I wouldn't mind keeping the simple plan, the set plan, because it's very simple, very low cost. Let's see how we do this year, because if you have an established couple years where you need to shelter some big money, that's where I would make the transition.
And this kind of goes back to some of the other things that we've already talked about when you have that gradual growth instead of those spikes, right? So if you can say like, okay, we're growing at a consistent rate, we feel comfortable, that's when you're able to really start making these bigger plan ideas, these 401ks, because you have the stability, you know that you're going to be, bringing in a set amount, or at least you expect it. So these plans work for that.
Yep.
You have salaried employees or, at least hourly employees. So these are all consistent things that are being done. Right?
Yeah. So say if you won the big contract this year and you're going to hire 50 more people, it may be, okay, let's just not contribute to our set plan. Kind of turn it off and see what happens the rest of the year. And then, okay, this is working out. We did get the contract. We did hire 20, 50, 30 more people. Okay, June comes around. Let's put together our 401k plan for this year.
Now, and another option, again, just trying to think about this, you get the contract this year, but you don't know if you're going to get a contract that's comparable next year. You may hold off, and then if you get the next year, be like, oh, we're kind of in, right? Like this is becoming a thing. You feel a little more comfortable. Yep. Now you can make that transition. Okay.
So one of the good things about the profit sharing component is you don't have to make that contribution each year. But once you establish a 401k plan, while you can change the match rate a little bit, you still have to let everybody participate, and you still have to put that match in for their share.
Okay. So the amount of contribution can be finagled a little
bit. The
bit.
match can be finagled, yeah. Okay. But the profit sharing, you can give them everything one year and nothing the next year.
Because you could have a bad year, too.
You could have a bad year.
Because it's profit sharing. If your profit was not great, there's not much to share.
Correct. It's just very hard
built into the name.
I always find once you give a benefit to an employee, it's very hard to not give it again.
Yes.
Like if you start having pizzas on Fridays, guess what? You're having pizza on Friday for a long time, or you're going to be people get mad.
But from a business owner standpoint, the profit sharing does make sense, right? Yep. Because your employees will know if you guys are doing well. Yep. If all of a sudden they're not working a lot, they'll be like, oh, they're probably not going to get too much, right? They understand that. Like an employee would understand.
Yes, they should. They might have some bad feelings. But the main reason for doing the profit sharing plan is that it allows you as the owner to put more money in. Mm-hmm. If your people are not participating, you are limited to how much you can put into that plan. Okay. So you want them to be part of it.
So let's move into pension, because pension is something we really haven't discussed too much, and it's something that can be tucked in these final months.
Yeah.
What are the options?
So when you say a pension, you mean we're talking about a contribution plan and not a traditional pension plan, because not many companies do full pension plan. Correct. Where you work there 40 years and they're going to pay for you for the rest of your life.
Those have gone the way of the dodo.
Those have gone, yeah.
Yeah.
If you remember those, you're a history teacher.
What can they do as far as a pension, I guess, option?
So the pension, if they don't have anything established,
the
only thing they can do is their individual retirement account, an IRA, that everybody knows. All you have to do is go to your bank. Your employees can do it. You can do it. And as long as you have wages, you can put a contribution in there.
Okay. And it would be a flat amount?
Or
you can say like every paycheck now,
Yeah, so you can do that to the end of the year, or you can save up your money and make that contribution right before you file your tax return. Okay. All right, but it's a much smaller amount. It's $5,000 or $6,000.
That's when it caps out.
That's what it caps out.
Okay.
So
is that taxable?
No, that's tax free. You get a tax deduction for putting it on there.
Okay. So let's. I just want to stop for a second. So right now, today, Mark, could just be like, "Hey, I'm going to go set this up." Or through my employee or whatever.
So you would generally set up an IRA, individual retirement account, by yourself, and you would establish it. You could have the payroll say, hey, I need you to put in $50 each paycheck for the rest of the year, and that'll count. Or you can put the money aside, and then you make the contribution into that account. Okay. All right? So the deduction is on your personal tax return. Okay. For that one.
In reality, this is an option not just for the employer.
Correct.
But the employee could also do that on themselves. Okay, cool.
So the one that the employer can do is a SEP plan, which is a small employee pension plan.
Okay.
And I want to say that one's 11 or 12 or 15,000 that you can put in.
Okay.
And again, you can establish that after the year end, but you can't put as much in as a full 401k, and there's no profit sharing component. It just establishes the plan, and then you can start putting money in, and you can do that at the end of the year.
So the SEP plan is better than like
nothing. And
it's better than nothing, right?
And it's better than an IRA.
Okay.
But there's no reason to do the SEP if you're only going to put in $2,000.
Okay.
Just do the IRA.
You're really, we're just looking at how much you're going to be putting in.
Correct.
If
it comes down how much money you have.
Yeah. Yep. If I'm only putting 2,000, the IRA is fine.
Because each one of those plans cost money. IRA doesn't cost you anything to establish, but a SEP plan does. And a 401k plan with all the bells and whistles is going to cost you thousands of dollars. But it's generally worth it.
It's also getting you something.
If you can shelter $100,000, I'll pay $1,000 for that.
Yeah. And the 401k is that premium, right? Like that's
everything.
The gold dream that everyone wants, because again, it's coming out of your paycheck. You really don't notice it, and that's your long haul, right?
And you, as the business owner, you can put in large chunks as long as you follow the formula.
And give me that quick overview of that formula.
So what I'm talking about is you can shelter, I think it's 54 or 64,000 this year. It does get indexed every now and then. So you and your spouse, as long as they're not participating alone, there's $100,000. Does that spouse
also have to be part of the business?
Well, you would make them part of the business, but they can. There's ways to put them on there, and that's $100,000 deduction. That as a regular employee, you can't get that kind of number in there of the total contribution.
That's beautiful. Yeah. All right, so let's do a quick recap. End of the year, really, they're just doing that the IRA, right? And profit sharing. Those are really the big options they have, or that
profit sharing if it's established.
Yep,
you have to have it already. Yep.
And how much time does it take to have that established?
How quickly can get that? Normally, you have to put it into your plan, but because it's the employer's money, I wouldn't make your investment person establish it on December 31st.
right.
Because that's when mistakes happen.
Exactly.
But you could add the profit sharing component to your 401k plan. So your 401k plan has to be established and give the employees 90 days.
Okay. So end of the year, what are the quick options that they got?
So end of the year, like today?
Yep, today, October, November, December.
You can just pick those three, say, let's see how much money we're going to have, and let's see if it's worth establishing one of these things.
Talk to your CPA and say, let's see, hey, here are the numbers. What can we do?
I want to see if I can shelter $20,000.
Okay.
All right. IRA's not going to do it. Let's see if we can do a SEP.
Yep. So, and then let's say it's not the end of the year, or you're looking ahead to the future. Say, let's see what options I have for a 401k, because you don't have to be a big business to have that 401k.
Nope.
You just kind of need to have that growth.
Yeah, and you don't have to have that many employees. In fact, if you have very few employees, all that 401k contribution goes to you. That's a win-win. So the thing you can be doing now is think about next year's 401k plan. Perfect. Right? So if we want to have that ready to go January 1st so that you can participate all year, now's the time to have that so it's ready to go.
Yeah, have that conversation, but don't expect it to happen.
It's not for 2023. It would be for 2024.
Perfect. All right, awesome. Well, thank you very much, Pierre.
Okay.
Pleasure having you as always.
You have been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you hear, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.